company in the United States, an empire hidden in glass towers that quietly manages $9.1 trillion, more financial power than Germany, Japan, France, and the United Kingdom combined, nations that together generate nearly $15 trillion of economic output every year, outmuscled by one private firm, one firm influencing over 5,000 corporations, shaping the direction of 90% of the S&P 500, casting more than 275,000 corporate votes every year. BlackRock. Most people can't name a single executive inside it. They don't know its floor plans, its systems, or its internal language. But its decisions affect 330 million Americans, 450 million Europeans, and indirectly, more than 3.5 billion people around the world. When BlackRock shifts its portfolios by just 0.25%, nearly $22 billion moves from one corner of the global market to another. During quarterly ETF rebalancing, $200 billion or more can change direction in a single trading day, enough to move stock prices by 5, 10, even 12%. No press conference, no speech, no vote, just silent reallocation. This is no longer a company, it has become the operating system for global money, and that operating system quietly shapes your life. Your rent? Institutional home buying programs backed by BlackRock and its peers have snapped up hundreds of thousands of homes since 2008, turning neighborhoods into yield machines and renters into permanent cash flows. Your retirement? More than 70% of American pension funds hold BlackRock ETFs. Your future sits inside BlackRock's models, even if you've never heard the firm's name. Your grocery bill? Commodity strategies overseen by BlackRock push hundreds of billions through agriculture and energy markets, affecting the price of food and fuel for over 115 million households. You see a higher bill at checkout. BlackRock sees models crunching 250,000 variables per second. Governments now rely on BlackRock's analytics to stabilize debt markets worth tens of trillions. Corporations depend on it to stay inside the index funds that channel over $5 trillion toward approved companies. Central banks, from Washington to Frankfurt, lean on BlackRock's risk models to guide policy decisions that shape $50 trillion in global GDP. You don't live in a free market. You live in a market curated, optimized, and quietly steered by one private institution. And here's the most important part. BlackRock didn't seize this power. Nations handed it over, not through elections, through dependency. Because when the world became too complex to manage, governments outsourced their financial imagination to the quiet empire. He was 35 years old when the mistake happened. Larry Fink watched $100 million vanish on the trading desks of Salomon Brothers in 1986. $100 million in the 80s, enough to end careers, bury reputations, and stain resumes for life. For most people, that kind of loss is a tombstone. For Fink, it was an obsession. He realized markets don't fail because of money. They fail because of miscalculated risk. If he could quantify risk, if he could build a machine that never slept, never panicked, never misjudged, then he could build something more powerful than any trader on Wall Street. A system that could see the crisis before it arrived. In 1988, with 8 employees, a borrowed office, and $5 million in seed capital, Larry Fink launched BlackRock. $5 million sounds insignificant compared to the $9 trillion it controls now, but back then it was a bet that the world's biggest institutions would stop trusting human instinct and start trusting models. The first clients weren't chasing hot stock tips, they were terrified of the future. Pension funds with obligations stretching 30 years ahead, insurance companies covering trillions in exposure, state governments whose budgets whiplashed with every recession. They didn't want cowboy traders. They wanted math. They wanted certainty. They wanted a machine that could read the world before the world changed. Fink gave them Aladdin, not a metaphor, not a cute nickname. A real system, initially 12 million lines of code, eventually expanding to over 5 billion lines by 2008. Aladdin became a crystal ball for global finance. Soon, it wasn't just tracking millions. It was tracking trillions. It monitored hundreds of thousands of financial instruments, every bond, every derivative, every obscure security. It could simulate the collapse of markets, scenario by scenario, shock by shock. And then the world started breaking. In 1994, the Mexican peso crisis. In 1997, the Asian financial crisis, vaporizing $2 trillion in value in under a year. In 1998, Russia defaulted. Long-term capital management imploded, nearly taking Wall Street down with it. One by one, nations learned the same lesson. They were blind, but Aladdin could see. By the early 2000s, BlackRock wasn't just advising banks, it was advising countries. It modeled national pension systems worth hundreds of billions. It analyzed sovereign wealth funds holding more than $1 trillion. It mapped mortgage risk across portfolios built from 12 million American homes, and every institution that plugged into Aladdin became more dependent on it. By 2006, BlackRock's assets surged past $1 trillion. 2 years later, as the financial crisis hit, it had tripled. Wall Street was burning, Washington was panicking, households were drowning, the U.S. Treasury and the Federal Reserve didn't rely on their own models. They called BlackRock. BlackRock was tasked with evaluating some of the most toxic portfolios in financial history. AIG, Bear Stearns, Fannie Mae, hundreds of billions in mortgages tied to millions of American families. In that moment, the transformation was complete. BlackRock wasn't just an asset manager. It had become a global operating system, a machine that governments trusted more than their own central banks, an algorithm that affected the lives of over 1 billion people, without a single election, without a single campaign speech, without a second of public scrutiny, while you slept, while you worked, while you tried to outrun rising rent and shrinking paychecks. The most powerful entity in modern finance quietly rewrote the rules of money. Most people have never heard the name Aladdin. They don't know its servers. They've never seen its interface. They don't know that every time their retirement balance changes, there is a good chance Aladdin had its hands on the underlying flows. Aladdin is not a cartoon character. It is a risk engine managing, mapping, and influencing more than $21 trillion in assets. That's more than the entire United States produces in a year. It didn't start that way. In 1990, it could barely map a $5 billion bond portfolio, but by the mid-2000s, it monitored trillions. By 2008, in the middle of the global meltdown, Aladdin had become the central nervous system for hundreds of institutions: pension funds, insurers, sovereign wealth funds, asset managers, and banks. Today, it watches over $21 trillion across more than 900 institutional clients in every major time zone on Earth. No central bank has that reach. Not the Federal Reserve with its $8 trillion balance sheet, not the European Central Bank, not the Bank of Japan, even after buying half of its own country's ETFs. They print money. Aladdin directs the money. Here's how it works. Before markets open, Aladdin runs millions of simulations. It stress tests portfolios against more than 2,000 risk factors: interest rate shocks, oil price spikes, currency crashes, political instability, weather disasters, consumer spending shifts, war scenarios. It can simulate what happens if unemployment jumps 2%, if mortgage defaults rise 5%, if a conflict in the Middle East pushes crude oil to $150 a barrel. Every scenario, every ripple, every forced seller, every casualty, Aladdin calculates it before you've even had coffee, and institutions obey it. If Aladdin signals danger, trillions of dollars move, bonds are dumped, stocks are snapped up, entire sectors rotate in minutes. The machine doesn't just watch markets, it moves them. Aladdin tracks more than 700,000 individual financial instruments. It can analyze hundreds of portfolios, each worth tens or hundreds of billions simultaneously. And the most dangerous feature? Aladdin has memory. It remembers every crash, every bubble, every anomaly. It stores decades of economic chaos. When a new crisis begins, it doesn't guess. It recalls, it compares, it correlates, it predicts. In 2008, as the mortgage market collapsed, Aladdin modeled fallout across 12 million individual mortgages faster than any Wall Street bank or government agency. That capability made BlackRock indispensable to Wall Street, to central banks, to entire governments. By 2010, Aladdin was serving more than 170 institutions. Today, it serves over 900. When Aladdin recommends a move, 900 institutions respond. When 900 institutions respond in the same direction, markets obey. You're not watching millions of independent decisions. You're watching a single machine guiding synchronized movement. And here's the part almost no one wants to say out loud. Aladdin does not belong to the public. It is not overseen by voters or legislators or independent watchdogs. It belongs to one company, BlackRock. No elections, no public audits of the code, no transparency into how its risk models shape the fate of your pension, your mortgage rate, your cost of living. If BlackRock disappeared tomorrow, the world's biggest portfolios would go blind overnight. Pension systems would convulse, insurance firms would freeze, central banks would lose their risk maps. Aladdin is a single point of failure on which much of the global financial system now depends. We were told central banks run the financial world, but every day, a larger part of that world runs through a private algorithm. Here's the part almost nobody connects. BlackRock didn't conquer the financial system by buying more companies than everyone else. It conquered it by owning the flow of money into those companies. Its most effective weapon wasn't lobbying. It wasn't even Aladdin. It was something far quieter. ETFs, exchange-traded funds. On the surface, ETFs are boring. A simple basket of stocks, a low-fee, passive way to invest. In reality, they became one of the most powerful tools in financial history. Today, more than $10 trillion sits inside ETFs globally. BlackRock's iShares platform alone controls over $3 trillion. $3 trillion, more than the GDP of the United Kingdom and India combined. And here's the twist. When you buy an ETF, you're not just owning a slice of the market. You are handing BlackRock your voting power. They don't call you. They don't ask what you think. They don't explain each decision. Your shares are pooled. BlackRock votes on your behalf millions of times per year. Board members, CEO compensation, corporate strategy, ESG policies, acquisitions and mergers. You think you bought a passive fund. In reality, you plugged your savings into a political and economic influence machine. Whenever money flows into a major index, like the S&P 500, the Russell 2000, or the NASDAQ, BlackRock must buy the underlying stocks. Not because the companies performed well, not because profits soared, not because innovation exploded, because the index rules say so. This means stock prices can rise without merit. Capitalism used to reward innovation. Now, index membership often matters more than performance. This isn't free markets. It's mechanical price inflation driven by flows. In 2021 alone, nearly $900 billion flowed into U.S. ETFs, close to $1 trillion of automatic buying pressure. 3 firms, BlackRock, Vanguard, and State Street, now collectively hold 15 to 30% of nearly every major U.S. corporation. Apple, Microsoft, Amazon, Chevron, Exxon, Meta, Walmart, Tesla. If you walk into a boardroom of any mega-cap company, there is a high chance one of the biggest voting blocks belongs to them. BlackRock doesn't need to own 51% of a company to influence it. If it controls the inflow of money into the stock, it controls the stock. And ETF flows are big enough to reshape entire markets. Today, ETFs account for nearly 40% of all trading volume in the U.S. equity market. 4 out of every $10 moving through Wall Street is moved not by human analysis, but by automated, rule-based ETF machinery. Asset prices no longer simply reflect value. They reflect index inclusion. Competitors don't rise because they're better. They rise because they're inside the right basket. Fundamentals don't decide valuation. Flows do. This is how bubbles form quietly, how markets become more fragile than they appear, how the real economy disconnects from financial reality. And for you, the consequences are brutally simple. Your rent, your retirement, your wages, your cost of living. All influenced by automated flows managed by firms you never meet in rooms you never see. The most personal battlefield in this story is not the stock market. It's your home. Somewhere between 2010 and 2024, the American housing market stopped being a path to the middle class and became an acquisition target. In 2012, institutional investors owned around 200,000 single-family homes, less than 1% of the market. By 2021, that number had doubled to more than 400,000. By 2024, estimates passed 500,000, and the trend is accelerating. BlackRock was not the only player, but it was the largest, the earliest, the most aggressive. After the 2008 crash, millions of homes fell into foreclosure. Families lost everything. Neighborhoods hollowed out. Entire communities were gutted. Who stepped in to buy those homes? Not the families who lost them. It was BlackRock, Blackstone, Invitation Homes, firms backed by trillions in capital. What the public was told was a once-in-a-lifetime housing crash was seen on Wall Street as a clearance sale. That was only the warm-up. The real shift began around 2018. Middle-class couples would bid $300,000 on a house. BlackRock or a similar buyer would appear with $330,000, all cash, no inspection, no hassle, 10-day close. You can't compete with that. You weren't bidding against other families. You were bidding against an empire. By 2021, nearly 1 in every 5 homes in some metro areas was being bought by institutional investors. In certain neighborhoods, 40%. And the moment these firms gained control, the logic changed. Houses stopped being homes. They became rental assets. Raise rents 5% here, 8% there. In some markets, more than 15% in a single year. Between 2020 and 2023, the median U.S. home price jumped from around $295,000 to over $400,000. A $100,000 increase in 3 years. Did your salary jump by $100,000? Of course not, because the market wasn't driven by organic demand anymore. It was shaped by institutional appetite. BlackRock's model is brutal and simple. Buy the homes, control the neighborhoods, turn families into permanent renters, extract rent as a steady, inflation-resistant yield stream. And the cruel irony? The same families who were outbid on their dream homes end up renting those homes from the institution that outbid them, for higher monthly payments, with no path to ownership. Your rising rent isn't random, it's designed. Housing used to be the foundation of the middle class. Now it is a line item in institutional portfolios, a yield generator, an inflation hedge, a securitized income machine. The American dream didn't just fade, it was quietly bought. You can trace the exact moment when BlackRock stopped being just another Wall Street firm and became the most trusted crisis manager of the United States government. It wasn't on live television, it wasn't in a public hearing. It happened behind closed doors in 2008, the year the American economy died on paper. Markets froze. 9 million jobs disappeared. $8 trillion in household wealth evaporated. Banks collapsed under the weight of mortgage-backed securities no one could value. The U.S. Treasury needed help. The Federal Reserve needed help. They didn't call the IMF. They didn't call the World Bank. They called BlackRock. Not because BlackRock was the biggest back then, not because it had the best reputation. They called because BlackRock had Aladdin, the risk engine mapping trillions in assets worldwide. BlackRock analyzed more than $1 trillion in distressed assets. It advised on the rescue of AIG, a $182 billion bailout. It helped unwind positions at Bear Stearns and evaluate portfolios at Fannie Mae and Freddie Mac. But there was a deeper consequence. By doing this work, BlackRock gained access to unprecedented information. Mortgage data, bank balance sheets, credit exposures, systemic stress points, the type of information you can't buy. Information worth billions, information no other private firm on earth had at that scale. 12 years later, in 2020, the cycle repeated. COVID hit, markets crashed. 30 million Americans filed for unemployment in weeks. The government prepared $3 trillion in stimulus and support. Once again, instead of building internal capacity, Washington outsourced. The Federal Reserve hired BlackRock to run programs like the primary market corporate credit facility and the secondary market corporate credit facility, together totaling up to $750 billion. BlackRock was not just advising the central bank, it was acting on its behalf. Buying bonds and ETFs, including BlackRock's own ETFs, using taxpayer-backed money. And imagine that, a private company allowed to buy its own products with public funds. And the official explanation was, it's efficient. Meanwhile, BlackRock executives flowed into the highest levels of government. Brian Deese, from BlackRock to the National Economic Council, Wally Adeyemo, from BlackRock's Chief of Staff to Deputy Treasury Secretary, Michael Pyle, from BlackRock's Global Chief Investment Strategist to Chief Economic Advisor to the Vice President. At one point, 3 of the most powerful economic roles in the U.S. government were held by former BlackRock executives, not elected, not chosen by you, but now deeply involved in steering economic policy for 330 million Americans. The same pattern repeats abroad. BlackRock advises the European Central Bank, the Bank of England, the Bank of Canada, the Monetary Authority of Singapore, governments in Greece, Ireland, and beyond. Governments aren't just clients, they are dependents, because when your financial system is fragile, the first call is no longer to a public institution, it's to BlackRock. A firm managing $9.1 trillion cannot remain domestic. By the mid-2010s, BlackRock was evolving from an American asset manager into a global operating system for capital. Europe felt it first. Between 2010 and 2016, BlackRock was hired multiple times by the European Commission and the European Central Bank to advise on banking reforms, rules that would define the financial lives of more than 300 million Europeans. BlackRock shaped the regulations that European banks had to obey, while simultaneously managing over $1.5 trillion in European assets. Regulators flagged the conflict of interest, but they still hired BlackRock because no one else had Aladdin's data. By 2020, BlackRock was the largest foreign asset manager in Europe, bigger than many household name banks in terms of influence on portfolios and flows. Then came the move that stunned geostrategic analysts: China. China rarely lets foreign firms dominate its domestic markets. It doesn't casually hand over access to its growing middle class. Yet, in 2021, China approved BlackRock as the first foreign firm allowed to operate a wholly owned mutual fund business inside the country. Not a joint venture, not a minority stake, full ownership. In a market worth $5.3 trillion. Why? Because BlackRock has what no government agency can match: granular, real-time insight into global capital flows. Data that can reveal strengths, weaknesses, vulnerabilities, and opportunities across borders. China wants that visibility. BlackRock wants exposure to its rising middle class. Both sides get leverage. Meanwhile, across Latin America, Africa, and Southeast Asia, BlackRock positions itself as the go-to advisor for sovereign wealth funds and national pension systems, the same funds that store the long-term wealth of nations. When governments need infrastructure financed, roads, ports, energy grids, solar farms, BlackRock appears with capital. When pension systems wobble, BlackRock appears with models. When crises erupt, BlackRock appears as the firefighter. But the firefighter also owns the building and designs the wiring. This isn't traditional colonization. No flags, no armies. This is something subtler. When a corporation manages your roads, your energy grid, your pension assets, your sovereign funds, your risk models, and your infrastructure plans, it doesn't need to control your politics. It controls your future. ESG, environmental, social, governance, was sold as a new moral framework for capital. In reality, it became one of the most significant levers of financial influence ever built. ESG ratings now guide tens of trillions in investments. BlackRock sits in the middle of this web, managing some of the most significant ESG-branded funds on the planet. Here's how the illusion works. When BlackRock or index providers downgrade a company's ESG score, capital flees, index funds rebalance, ETFs sell, share prices fall automatically, mechanically, without a single human hand needing to push the button. One scorecard, one adjustment, billions of dollars rerouted. This isn't democracy. It isn't even a traditional regulation. It's algorithmic governance. More than 90% of Fortune 500 companies now publish ESG reports, not because they woke up one day and discovered religion. But failing to comply could mean losing access to the $22 trillion managed by BlackRock, Vanguard, and State Street. ESG became a tool not just for measuring behavior, but for enforcing it. And the results are often incoherent. In 2022, Tesla, producing over 1 million electric vehicles per year, was removed from a major ESG index. ExxonMobil, pumping millions of barrels per day, remained. Why? Because a tangle of governance and disclosure metrics overpowered basic environmental logic. This isn't about saving the planet, it's about controlling capital. Whoever controls the criteria that unlock tens of trillions in ESG-labeled funds controls which industries live and which slowly suffocate. And BlackRock sits at the center, part referee, part judge, part beneficiary. Every era has that one institution that grows too large, too central, too embedded. In the 15th century, it was the Medici Bank. In the Age of Empires, it was the British East India Company. In early 20th century America, it was J.P. Morgan. When they stumbled, entire systems shook. In our era, that institution is BlackRock, with $9.1 trillion in direct assets under management and $21 trillion more running through Aladdin's system. BlackRock has become a systemic organ, a heart pumping capital through the arteries of the global economy. If the heart stumbles, the body stumbles. Aladdin doesn't just analyze markets, it shapes them. It tracks a massive share of global institutional investment flows. It runs millions of risk simulations daily. It processes data for thousands of portfolios and hundreds of institutions. This creates a feedback loop. Aladdin predicts risk. Clients react. Markets move. Aladdin reinterprets the move. Clients react again. A self-fulfilling prophecy built on trillions. If Aladdin miscalculates, the world miscalculates. We've already seen what happens when a single algorithmic strategy goes wrong. Flash crashes, volatility spirals, currency shocks. Now imagine that kind of miscalculation at the scale of BlackRock. And remember, BlackRock, Vanguard, and State Street together control about $22 trillion and often sit as top 3 shareholders in over 90% of the S&P 500. Their models are correlated, their holdings overlap, their flows converge. One shock, one error, one liquidity crunch, and trillions could move in the same direction at once. This isn't just too big to fail, it's too interconnected even to understand the failure. Here's where the story hits home. Inflation is not just an economic metric. It's an extraction mechanism. You feel it at the gas pump, you feel it in the grocery aisle, you feel it when your landlord raises your rent again, your wages don't keep up, your savings buy less, your margin of safety shrinks. But for large asset owners, inflation often does the opposite. Real estate values climb, commodity funds gain, corporate revenues rise in nominal terms. When inflation rises by 6%, your salary might stagnate. But the nominal value of BlackRock managed assets often increases, and BlackRock earns its fees on total asset value, not on your quality of life. Your groceries, your housing, your fuel, they're all inputs into someone else's yield model. In housing, institutions bought hundreds of thousands of homes. Rents rose nationwide 20, 30, even 40% over a decade. In cities with the heaviest institutional ownership, rent inflation was often the most savage. You're not failing to keep up because you're lazy. You're failing because the system is literally built to push you behind while assets climb ahead. Your retirement is tied to index funds run by the same firms that own your landlord's REIT, your grocery chain stock, and your utility company's bonds. Whether markets go up or down, BlackRock collects its fee. You take the risk, they take the rake. BlackRock isn't satisfied managing $9.1 trillion today. It wants a role no empire in history has ever achieved: control over the world's infrastructure, the world's financial plumbing, and eventually the world's economic decision-making frameworks. Because money isn't power. Flow is power. And BlackRock wants to control the flow. Governments are drowning in debt. U.S. national debt, European sovereign debt, local government debt in China. The numbers are so large that traditional tools no longer work. So where do governments turn? To the one entity large enough to absorb multi-trillion-dollar problems. BlackRock. It is raising tens of billions for infrastructure funds, buying toll roads, power grids, ports, water systems. These are not just investments, they're choke points. Whoever owns infrastructure owns the economy that runs on top of it. At the same time, BlackRock is pushing deeper into digital finance, Bitcoin ETFs, tokenized securities, programmable assets. As money becomes more digital, programmable, and trackable, the software that runs those rails becomes more powerful than the governments that issue the currency. BlackRock doesn't want to replace central banks. It wants to become their operating system, to model their decisions, to route their flows, to manage their balance sheets. In country after country, it is already advising how to structure pensions, how to direct climate investment, how to manage sovereign wealth, how to navigate demographic decline. These are rehearsals for a future where governments, exhausted by debt and constraint, quietly outsource their economic steering to corporations that promise efficiency and stability, a future where BlackRock doesn't need to rule nations, because it runs the systems nations require to function. History is clear. When private wealth outgrows public authority, one of two things happens. The state breaks the private power, or the private power captures the state. We've reached the first era in human history where corporations collectively manage more capital than countries, where algorithms move more money in a day than legislatures can move in a year. Governments are overloaded with debt. Corporations are overloaded with cash. States are losing fiscal sovereignty. Balance sheets are breaking. Capital has already chosen its champion. BlackRock, the collision is coming, not on battlefields, but in bond markets, currency markets, liquidity crises, pension panics, ETF rebalancing shocks, credit downgrades. If governments push too hard on regulation, capital can punish them. If corporations overreach, public backlash can erupt. Either way, the person caught in the crossfire is not the policymaker. It's you, your job, your rent, your savings, your retirement. Sitting at ground zero of a showdown between nation states and data-driven empires. Most people hear $9.1 trillion and think it's abstract. They hear $21 trillion overseen by Aladdin and assume it's irrelevant. They hear global dependence on BlackRock and think it's a problem for politicians and CEOs. But the consequences land inside your life. Your rent is not just a market outcome, it's a financial product. Your retirement is not just your money, it's a small piece of a massive algorithm. Your job stability is not just about how well you work, it's about whether your employer's stock remains attractive to ETF flows. Your purchasing power is not just a function of hard work, it's shaped by an inflation regime designed to protect asset owners first. You vote every few years. BlackRock reallocates money every millisecond. Which has more influence? A ballot box? Or a $20 billion ETF rotation? The harsh truth is this. You're living inside an economic machine that was not built for individuals. It was built for scale, for institutions, for trillion-dollar balance sheets. BlackRock is not a villain in a movie. It is the motherboard of that machine. Your mortgage, your rent, your 401k, your city's bond market, your country's debt. all route in some way through systems that BlackRock either runs, models, or influences. If you feel powerless, it's not an illusion. The power was transferred years ago, not with a coup, not with a war, but with contracts, with models, with risk management, quietly, efficiently, permanently. There comes a moment in every empire's rise where power stops being visible. It stops wearing crowns, it stops flying flags, it stops marching armies. Instead, it moves silently, through balance sheets, through indexes, through code. BlackRock didn't conquer the world with tanks. It conquered it with $9.1 trillion in assets, an influence over 21 trillion more through Aladdin, a combined reach larger than the economies of the United States and China put together. No generals, no elections, no parades, just scale. Scale so large it becomes invisible. Scale so deeply embedded it looks like how things are. That's what peak empire looks like in the 21st century. Not drama, silence. BlackRock doesn't need to rule countries because countries now depend on it. When the US Treasury panicked in 2008, it called BlackRock. When markets froze in 2020, it called BlackRock. When Europe needed help stabilizing its pension frameworks, it called BlackRock. Dependency is not an accident, it's a design. Once systems depend on an empire, that empire doesn't need to shout, it just needs to exist. You don't see the decisions being made, you just feel the consequences. Rising rent, shrinking purchasing power, volatile retirement accounts, inflation that always seems to hit you harder than it hits them. You're told it's the economy, but the economy doesn't move by itself. Capital moves it, and capital moves where the operating system tells it to. For centuries, great empires projected power outward. Roman legions, British fleets, global armies. The most powerful empire of our time doesn't project power. It absorbs it, not with land, with information. And in a world defined by volatility, the empire that sees first rules longest. BlackRock sees more than any institution in financial history. This is the quiet empire at its peak.